Good afternoon, everybody. This is Wes Cleckley with Interlink Mortgage. It is a little after 1 o'clock on Thursday, but I wanted to come to you guys with an update and try to shed some light over what's been happening over the past week, really this whole year, and give you some real information on truly what impact the Fed has, what inflation has on mortgage rates, and maybe kind of fill you in on some of the information or disinformation you're receiving from the media and social media. I'm looking at Facebook right here, and I mean, there's all kind of stuff here. So, wanted to give this information, wanted to give you some facts, maybe calm everybody down a little bit. But as you all know, since the beginning of the year, rates were around 3%, a little above three. They've actually pushed into the sixes, believe it or not. We're still locking some in the fives, but it really depends on loan product, credit score, total loan amount, and many other factors. But they pushed into the sixes. Um, and why have they really pushed up? They've actually increased about a 0.5% since last week. And what was the big driver? The big driver, and really what is really the main reason, the main driver of these interest rate hikes, these mortgage interest rate hikes, is the rate of inflation. We're at a 41-year high in inflation. Hadn't been this high since 1981. And what happened on Friday, that's when things really started getting ugly. What happened on Friday, the CPI came out, Consumer Price Index, measure of consumer inflation. It was expected to be 8.3%, and it came in much hotter at 8.6%. So that made the stock market sell off. I believe the Dow Jones fell almost 900 points, but it also caused mortgage rates to go up. So the price of the mortgage bond plummeted. It caused the yield or the rate to go up as well. Monday was even worse. It was one of the worst days in the mortgage market that we've seen. And at one point, we were down 170 basis points. That's, three-quarters of a point movement in one day in the actual rate. So anyway, we've lost at least about a 0.5%, or we gained a 0.5% in rate. So if the rate was 5.75 for your scenario last week, it'd be closer to 6.25 today. So after all that happened, all that turmoil, then the Fed comes out and does their monthly meeting yesterday, and they had projected over the last few weeks that they were going to raise the Fed funds rate, the 24-hour overnight rate that banks pay each other to borrow funds overnight. That's what the Fed manipulates, right? They raise it up, they raise it down. So they had projected they were going to increase rates by 50 basis points, and they actually increased it by 0.75, so 75 basis points, three-quarters of a percent. So it went from 1% to 1.75. Everybody's freaking out. I had so many calls from clients and agents that they wanted to lock their interest rate in before 1 o'clock. So why does the Fed raise rates? You're thinking, well, mortgage rates are already high. People are already feeling it in the pocketbook. Why would they raise the cost of borrowing? Well, they're simply doing it to stave off inflation. Again, inflation at 40-year highs, they're trying to bring inflation down. So the higher the Fed increases interest rates, it will slow the economy. And when the economy slows, it will bring inflation down. That's the goal anyway. So everybody's freaking out about it raising 0.75. It's really a good thing they did. And I was advising people that wanted to lock before 1 o'clock. I said, listen, just because they're raising the short-term rates does not mean that's going to be a 75 basis point or three-quarters of a point increase in mortgage rates. And it ended up being true. What actually happened, they raised the Fed funds rate by 75 bips. Mortgage rates came down. So at the end of the day yesterday, they had decreased by about 0.25%. Why does that happen? Well, the market, the bond market out there, perceived that the Fed is finally getting serious about inflation. And when inflation comes down, long-term rates, mortgage rates, 10-year treasury notes, they actually come down. And that's exactly what happened. We were up 120 something basis points in the bond market, which actually brought rates down at the end of the day. So it was actually a good thing. However, we wake up this morning, it's a different story. I woke up this morning, we'd almost given away all the gains we got yesterday. We were down 90 something basis points when the market opened. Why did that happen? Well, reports from across the globe, other countries' central banks actually raised their short-term rates higher than expected as well. So why didn't it have the same impact that our Fed did yesterday? Well, it's because it puts a larger global fear that inflation is even more of a threat than everybody thought it would be. So the knee-jerk reaction of the market, the bond was down 96 basis points, affected mortgage interest rates by another quarter. So we're about even where we were yesterday. All right, but we've gained some ground back. We were down 95 basis points or so. We're down 39 basis points now. Stock market is doing terrible because, again, it's all about inflation fears. So look, not all is not lost. A lot of people are making a decision whether it's time for them to buy a house or not, or just kind of sit on the sidelines and wait. Look, I believe if you need a place to live and if you want to buy, I still believe it's a good time to buy. Now, you obviously have to be comfortable with your mortgage payment, right? So we're never going to encourage you to pay a mortgage payment at today's locked interest rate if you're not comfortable with it. One, we're going to look at your budget with you. Do you qualify for one? And two, are you comfortable with it? Does it fit in your budget? Because here's what you need to remember. Just because you get a 30-year fixed rate, say it's at 6% today, just because you get a 30-year fixed rate at 6%, that does not mean it's your forever mortgage. These rates will come down probably in the next 12 to 18 months. Markets go up, markets go down. People forget in 2019, rates were in the fives. We refinanced every one of them back in 2020 when rates got down into the threes and the twos. So save those folks thousands of dollars. But they were able to get in when they bought and enjoy the appreciation in the investment that they made with all these home prices going up, right? So I still think home prices are going to go up. Yes, the crazy appreciation we've been having is going to flatten because it can't stay at that rate of increase forever. But listen, we're still short inventory. In equilibrium in the market is about a 6-month supply of houses, and we're running around 2 months, give or take a little bit. So we're still short inventory. They're not able to build them fast enough. So the demand for housing is still going to be high, even though some people are sitting on the sidelines because of rates. But what I mean is, if you buy today, more than likely that house is going to be worth more in 12 months, especially in 24 months. So if you buy today, you're locking in today's price. Yes, the rate may be higher, but you will have the opportunity, I firmly believe, in 12 to 18 or 12 to 24 months to refinance that. You may be able to refinance back down to the fours. We may be back down in the threes. But as soon as inflation gets under control, it may start turning in the fall, is what it's projected to do. So once inflation gets under control or starts going in the right direction, you'll see the market rally. You'll probably see the stock market rally, and you'll see the bond market rally, which will bring long-term mortgage rates back down and give us some relief. But again, if you need to buy a house, right now is still a good time. But give me a call. I'll be glad to run through your specific scenario, talk through all the options with you. And if it's not right for you to buy, no problem. It doesn't matter to me if you buy in 3 months or 3 years. I want to inform you and equip you with the right information and the facts that will help you and your family to make a right decision. But anyway, wanted to get this quick video out there to inform you guys. If you got any questions, don't hesitate to call me. You can reach me at 210-202-8080. And I look forward to hearing from you. Enjoy the rest of your day. Bye-bye.